You look at, say, something like silver. I'm going to just go back and don't focus on the pricing. Focus on the size of the charts. You start getting these gigantic valuations that are multi-hundred. It could even be $1,000 an ounce. Now, people are going to say, "Well, I don't understand. I can't fathom that type of move. I don't understand what you're saying here. How can we get to 1,000? How can we get to 500?" It's not silver, guys. It's not copper. They're all suggesting that the dollar is going to eat it. That's what that's suggesting. This is the gold price in relationship to the M2
Hmm.
money supply. This of 2000 to 2011 was in a basing period. So this is a base
Right.
of a big double bottom, and then we're going to break out of this base and go into a really fun period for gold owners.
The setup for precious metals continues to strengthen as inflation, debt, and long-term interest rate trends converge toward a breaking point. Gold and silver are showing classic consolidation patterns within a massive structural breakout, setting the stage for a historic upside move. When currencies weaken and bond markets lose stability, capital eventually seeks refuge in real value, and this time, that refuge looks poised to deliver extraordinary returns. The dollar's decline isn't a temporary trend, it's a systemic outcome of years of artificial rate suppression. As liquidity shifts away from bonds and stocks, the next logical destination is hard assets. Andy from Findingvalue Finance, a long-term commodities investor and macro trend analyst, explains that silver's setup mirrors previous primary cycles where suppressed valuations exploded once confidence in fiat systems eroded. Gold's relationship to the M2 money supply also points to an imminent breakout phase, similar to the early 2000s bull market, but with far larger potential. The pressure on policymakers to protect the bond market will likely come at the expense of the currency, leading to a rapid revaluation in metals. Now, we present the clips from Andy's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I think it's just a short-term consolidation pullback. I don't think it's anything major where we'll be down for like it's not the end of the bull market in 2011 or something like that. So we're in a consolidation. Could it go on for a little bit? It could. I'm not saying that I know the short term here. Could we fire off and just keep ripping to the upside? I think that's a high probability as well. So yeah, I've got the chart there. We can dive in more towards the shorter term here. There's that consolidation. We are getting some. I can remove this. We are getting some buying pressure here, where we could be trying to bottom and start to try to
Mm.
turn higher. Usually, if you dive in on the very short term, we've pulled on back here. We have a little bit of resistance coming through this section there. We've got the lows coming on up, so we're going to try to break at least this resistance area here and move on up. So once you kind of break that, create a higher high out of here, you could start into a higher high, higher low scenario where maybe we re-engage an uptrend. So I don't think it looks bad. We're just waiting to see if we can re-engage to the upside for gold in the short term. Now, I don't trade the short term. I do watch it. I don't really trade in and out. I'm more of a kind of the long term look at this stuff. So when I look at it, I look at it from this view, and then I usually put the 10-year on here underneath it, and that's the
Mm.
view that I view almost all of my investments from. Is we've got the broken downtrend, the upside move. So I think that this move here was in an increasing interest rate environment. It wasn't freely traded back here. You got that, and then we consolidated. This whole thing here is like a cup and handle, just like silver is. This is one big consolidation, and we've broken the consolidation. So this is game time. So whatever short-term pullbacks that we are experiencing in the short term here, I think they're just small consolidations. So when you look at, say, something like gold in relationship to the M2 money supply, you were in a base configuration. So the 70s was a big bull market with increasing interest rates. This is the gold price in relationship to the M2
Hmm.
money supply. This of 2000 to 2011 was in a basing period. So this is a base
Right.
of a big double bottom, and then we're going to break out of this base and go into a really fun period for gold owners. That's what I'll say. It'll be a very fun period for gold and silver owners, commodity owner, asset owners, and stuff like that. It's not going to be like the 2000 to 2011 movement. And this is the reason why. The reason that this period will be different than this period is we had declining interest rates that were low that kept money in the stock market. So even though we went sideways in the stock market some, we didn't really break the big uptrend. So we went up, we went sideways, and then we went up again, and money stayed there more so than it will, I think, this time around. Well, I see the trend going up, but that doesn't mean that I know the path. So
Right.
what a lot of people, when I say I see a trend going up, that doesn't mean that it happens immediately and it will be continuous.
Or it'll be
So
a
if
straight
this
line,
does something like this and then does that, it could do something like that for sure. Or it could loop back around like this. I'm not stating that I know with 100% certainty that this will occur, but this could be, it would be a cup and handle pattern if it were to do that. If
Right.
because you came from the bottom here at 2000 and then you create the cup and handle on the ratio chart. But I'm not stating that that's what was 100% going to happen. Inflation impacts bonds where people want to sell bonds, increasing interest rates. As interest rates go up, so we're breaking out of this downtrend in interest rates here in the short term. And I think eventually we will break out. There's a big consolidation. I'll show you here. We will break to the upside of that consolidation on the bigger picture, longer term view. And what I mean by that is this consolidation there. This will break to the upside. And once you start to eclipse this 5% area, that's going to put pressure on the overall stock markets. So the S&P 500, the NASDAQ, when we start getting above 5%, it'll put pressure on that. Bonds are already selling off. That's why interest rates are going up. And then money is going to say, well, where do I want to go? It's not going into stocks because they'll be coming out of it, and it's not coming into bonds. So two asset classes are quote down, and then money's going to say, where do I go next? And it's going to go into gold, silver, and you're just going to see this continually go up for however long interest rates go up. And it will be the same dynamic that we saw. And I'm going to just use silver here, and just to show you guys, this is where I get the confidence to hold long term. So it's that this move there, and then the interest rate. So that's all coming again, and we're just starting to break out of that. So if they try to do QE and they try to hold interest rates down and keep the stock markets up, I think they're just going to blow these things through the roof. So that's why I'm in gold and silver, because I think they're going to try to do something like that because of the debt situation that they're in. But they don't determine the interest rates. The market's going to force them to do something. And then if whatever situation they're in, I mean, this isn't, there's situations that you're in, like you've got problem solution, and then you're in predicaments. I think they're in a predicament. It's not a problem solution. So they don't have a solution for what's coming. They're going to be stuck at managing outcomes. They're going to say, well, do we want to blow up the dollar or do we want to save the bond market? Like that type of situation, I think, is coming. And I don't know when, but it will come. They'll be forced with it. And then if they whatever they decide, they'll either let interest rates go up to save the bond market, or they transfer that pressure in the bond market into the currency, where they hold down interest rates and destroy the currency. Most of the time, I think governments will choose to destroy the currency and save the bond market. So they'll probably hold interest rates down with QE or something, and then just blow up the currency. We'll lose a lot of purchasing power in the currency, which then gold, silver, and all of these commodities and emerging markets, they're all going to just be sent to the upside. Last time we saw similar things where the dollar fell. We saw things like emerging markets. I'll just use Brazil as an example. We saw a 20-fold increase when we saw the dollar get smoked. And we are in the beginning stages of that type of move. So it's not gold going up, it's the dollar getting smoked. It's not necessarily EWZ going up, it's the currency exchange rates and money flowing from those currency exchange rates that is causing this. So if we were to do like the Brazilian real versus the dollar, you get this double bottom. So here's your falling wedge. So that means that the buyers are equaling the sellers into the corner here. Then you get a bottoming pattern at the bottom here, usually an inverted shoulder, head shoulder, or a double bottom or something. Could be a triple bottom, whatever the bottoming pattern is, which we have a double bottom. And then I think we're going to head on up. And I mean, it's possible that we could do something like that to a triple bottom or something, but
The setup unfolding across precious metals and global currencies points toward a significant structural shift. Silver is sitting right at the edge of a 45-year cup and handle formation, the same kind of technical base that preceded explosive moves in 1980 and again in 2011. Each primary wave of monetary expansion has historically triggered similar reactions in silver, and the charts now suggest that a breakout could send valuations into multi-hundred or even $1,000 territory per ounce. But it's not really silver going up. It's the dollar losing purchasing power against tangible assets. The same dynamic applies to gold, which continues to trade in a robust long-term base relative to the M2 money supply, positioning it for a significant revaluation once the next liquidity wave hits. As currencies weaken and capital rotates out of overvalued dollar assets, precious metals appear ready for their next major leg higher. Let's get back to the interview.
silver's gonna, so we're right at the 45-year cup and handle. So if I were to show you guys, like if this was the time to do it, this is the time to do it. We're right there at that breakout. If they're going to do this, every time they print money, silver's like the reaction to this money printing. It did it in 2020. It did it in 2008-9. I don't know if you remember back then, but they also did stimulus. George Bush sent out checks. And then gold and silver ripped off that 08-09 bottom, which was right here, since I got the chart up. That was right here then. Where is it? Right here. So that's 08-09, and then it just ripped. It was this great vertical shot. So I think maybe it's already pricing some of that in because it's going vertical, but I think we're gonna hit it here. I mean, there's a possibility if he does this and it's a decent increase of currency. I mean, I don't think the tariffs are funding that. I don't think he collected that amount because we're still running deficits. So wherever this money is going to come from, they can say it comes from tariffs, but I think it's going to be expansionary. And you look at, say, something like silver. I'm going to just go back and don't focus on the pricing. Focus on the size of the charts. And when you look at, say, something like this big cup and handle, and then you start to project things up and whatnot. And I know I've got crap all over, but you start getting these gigantic valuations that are multi-hundred. It could even be $1,000 an ounce. Now, people are going to say, well, I don't understand. I can't fathom that type of move. I don't understand what you're saying here. How can we get to 1,000? How can we get to 500? It's not silver, guys. It's not copper. They're all suggesting that the dollar is going to eat it. That's what that's suggesting. So if it makes you feel better or it's easier to handle, it's the dollar having the issues, not silver and the supply-demand characteristics of silver. Even though there is supply-demand characteristics that are positive for silver, it's dollar denominated. All these are measured in silver divided by dollar. It's a ratio.
Right.
And the ratio is priced in dollars. Now, if I were to take, let's just do XAU to have a cleaner chart, because I don't think I have as much on this one. If I were to take this, and I've got we'll do an experiment here. So this is gold priced in dollars, right? And people are like, okay, I get it. If I put this in Japanese yen, you're going to get a different looking chart. And it's going vertical, but the price move may be at a different rate of change. Now, if I put it in something else, say something like the Canadian dollar, we get a little bit different looking chart. So it's not the same exact chart, but I mean, look at this thing move from $500 in 2002 to 5,649. Is gold changing here, or is it just different ways of pricing gold in different currencies? So what I'm saying here is the currency, which this one's in the Canadian dollar because I swapped it up here, even though it says USD here. It's the currencies that are the issue. And the way that these things move, if I were to pull like a Canadian dollar USD and see how this was the last bull market in commodities. It's not commodities themselves necessarily. It's currency exchange rates. And yes, there could be pressures that build in commodities that create these currency exchange rate differences. You could maybe argue that. But what's coming in the setup, whatever the reason is behind it, it's all lined up in a falling wedge ready to break here at some point. And it looks very similar to the same setups before that went, the fractal patterns that were
Mhm.
created. And if you sprinkle in the other currency exchange rates like BRL USD, African Rand USD, and it's like these things are all lining up for a big exchange rate currency difference, the way that money flows. So money were flowing into the USD and it's going to be flowing out of USD as these go. And it's not in one chart, it's in all of them. I can pull up great, the pound sterling, that's broken out already. The USD is going to get hit, is what I'm saying. And commodities, energy, precious metals, and then the other markets in the world are going to go up. It would be my estimation because of these currency exchange rates and how money is going to flow in the system. So in the short term, I think the DXY is going to go up. In the longer term, BRL, Brazilian Real, USD is going to go up. But there's a combination where you could have the Real go up against the dollar and the DXY go up at the same time because they are comparing against different currencies. The DXY is compared against a bucket of like euro and yen and whatever else is in there. And I think the Canadian dollar's in there too. And then the Real, I don't think it's in the DXY. So this could go up with the dollar DXY going up too. So it gets a little bit difficult when you're looking at these like the DXY because it's all relative. It's not an absolute value. Each of these currency exchange rate differences when the DXY falls, this was the 1970s to 1980 bull market of commodities. Here's another bull market down here. This was 2002 to 2008, 11. 11's the one there. And if this falls again, which I think it will with time, I'm not stating in the short term because we could still do something like that. And then roll over. So we could get another one of these humps, so to speak, and do something like that. Then your bull market's going to come and it's currency exchange rates. What happens with currency exchange rates is when money flows into dollar denominated assets, you get a move higher. Think of it as the market condition of low inflation, low interest rates. And that's what we had from the fallout of the real estate market in 2008. We had that big fallout. So this was the boom and this was the bust. The bust was all here. And then we came up because we had no inflationary pressures driving from monetary debasement and fiscal spending wasn't as bad as it is today. So we had low interest rates, low interest expense, all that stuff, kind of the Goldilocks period. And during a recovery phase of real estate, money flows into dollar denominated assets and pushes the dollar higher and S&P goes up, NASDAQ goes up. And I think we're getting close to the end of that condition. So as you roll on over, inflation kicks up, interest rates kick up, and then money starts to flow differently in the markets. So if I were to kind of state my opinions here, currency exchange rates and the way that money flows in the system based off the market conditions of interest rates and inflation, it just changes the way that money moves. And everything that I look at from a charting perspective, like say emerging markets and commodities, it correlates with that condition. So we get a consolidation in that certain condition here where this is emerging markets ETF that I'm showing you.
Mm-hmm.
In that condition, we had a consolidation. And then after the consolidation, which ended, say, here in 2022-3, we're going to break out to the upside. And this consolidation will turn into a launching pad where the dollar will weaken. Money's going to flow from dollar-denominated assets to commodities, precious metals, and emerging markets and international funds and stuff. And this will break and be a launching pad. And last time in the 2000s, that was a different market condition than what we had today. Because in the 2000-ish area, it was a declining interest rate environment. It was in a consolidation. So if you were to look at something like the S&P 500 on a longer term scale, the bull market of lowering of interest rates, the ultimate bottom was 74, but the tailwinds really started in 1982, which is that area right there. And that created this gigantic bull market all the way up. Now, this here was the commodity bull market, but I think it was just a halfway pattern between 82 to where the top will be wherever it ends up being. And interest rates are going to they're going to go above about 5%. And this is going to start to chop sideways or pull back and go lower. When you get that, the combination of the declining bond market and the pressure that's going to be put on the stock market eventually, I'm not stating I know the exact top. Money is going to start to flow differently, and we're going to see a rush in there. And then all of our ratios that I track, like gold 10 to money supply, they're all going to go way up to the upper end, I think, of those ratios.
The global financial structure is reaching a pivotal turning point, one that could redefine how capital flows across markets. Precious metals are positioned to benefit as inflationary pressures, rising interest rates, and weakening currencies converge into a perfect storm. The long-term patterns across gold and silver charts reveal monumental basing formations that typically precede explosive price moves. Silver's 45-year cup and handle setup, for instance, signals the potential for historic gains once monetary expansion resumes in earnest. Gold, too, is aligning for a breakout when measured against the M2 money supply, suggesting a powerful revaluation phase ahead. As global exchange rates shift and capital exits overvalued dollar assets, commodities, energy, and emerging markets are likely to absorb that flow, sparking a new cycle of wealth rotation. This next phase won't resemble the 2000s bull run. It's larger, deeper, and driven by structural debt imbalances rather than cyclical recovery. Those who understand the currency mechanics and position early could stand to benefit most as the dollar weakens and tangible assets rise. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.